10-minute top 10 on year-end tax planning. Welcome back to SPG Advisors. My name is Tyler Lively, and we are going to jump into some very helpful tools for every single retiree as they prepare to look at year-end tax planning. I've got 10 things to go over today. It's going to be quick. It's going to be sharp. It's going to be fun. Let's jump in. First and foremost, everyone should look at the possibility of doing a Roth conversion. A Roth conversion is where you take IRA funds, you convert them, meaning you pay the taxes now from your traditional IRA to your Roth IRA, which allows for growth that's tax-free, which allows for distributions that are tax-free, and which allows for those funds to go to heirs tax-free. Now, it's important to look at what tax bracket, which income you have, which we're going to get to later in our top 10. But Roth conversions is always a great tax planning tool to be able to see, again, where you are in the tax bracket and if there's any additional money that can be, quote unquote, converted and stay within the tax bracket to allow for future tax-free growth. For an example, let's say I'm partially into or halfway into the 22% tax bracket. I could convert anything or everything else within the 22% tax bracket, pay those taxes, and then have all future growth and that money be tax-free. It's a great year-end tax planning tool to see if it works for you. The second thing is to really look at in your non-qualified or your non-retirement accounts, how much dividends and interest are coming out. If you're in a dividend portfolio or in a money market that's earning 4%, it's important to look at your month-end statements to truly see how much money is coming out or being taxed in regards to dividends and interest. It's one of those kind of like hidden gotcha moments at the end of the year when you get a 1099 and it says you had $30,000 of dividends and interest. I know that's a little high, speaking out loud, but most people don't plan on that hidden income that just goes into your brokerage account. But it's something that you should be planning for and looking into before it comes due on April 15th the following year. Number 3, let's jump into the Big Beautiful Bill Act that actually added an additional $6,000 of standard deduction to each individual above age 65. That actually becomes a really interesting puzzle piece to fit in with Roth conversions. It may make less sense in 2025 to look at Roth conversions because of that, depending on your income. If you're married filing jointly, there's actually phase outs between 150K and 250K. And if you're single, it's 75 and goes up from there. But it's an interesting and important thing to look at if you're looking into Roth conversions or not, is seeing if you can qualify for that additional $6,000 added to your standard deduction. So a very important thing to look out for in regards to year-end tax planning. The fourth one, if the majority of your portfolio is in, again, a non-retirement account and in mutual funds on the whole, on the majority, have a mandate to distribute capital gains by the end of the year. And what's surprising is most of them choose like December 16th to pass through those capital gains. So what's interesting is you'll see on your December statement, especially I would look at last year and see what happened, but usually like the second to third week of December, there can be large capital gains pass-throughs that are then, again, taxable. And that can be another thing that's added on those 1099s that can be sometimes a gotcha moment for retirees. So I would really look at your December statement last year, and if your portfolio is in a very similar mutual fund makeup, try to extrapolate what the capital gains pass-through can be this December so you can prepare for it and you prepare to pay taxes for it, again, starting next year once you receive that 1099. Let's jump into number 5, RMDs, or required minimum distributions. Again, anybody over age 73 now, and depending on what age you are, it could have been 72 or it could have been 70 and a half. Everyone is required to pay or distribute a portion of their traditional IRAs and pay the taxes. It is imperative to be able to take the required minimum distribution by December 31st. If it's your first year, it can technically be April 1st of the year you turn your RMD age, which I think is funny. April 1st. I wonder how the IRS came up with that one instead of April 15th or something else. We all wish it was an April Fool's joke, but it's not. So Usually, December 31st is the due date for your required minimum distributions, and it is imperative that you take them, because if you do not take enough, there is a penalty, and it's a pretty hefty penalty. It used to be 50% of the amount that you didn't take would be charged a penalty. They've reduced it. Congress has reduced it now. It's less than 50%. I think it's around 25, but there's still a penalty. So make sure you take the required amount out of your traditional IRAs to make sure that you've satisfied that requirement. The next thing, which is an interesting tax planning tool in regards to RMDs, so this is number 6, it's called qualified charitable distributions. For anyone over 70 and a half, you can technically take pre-tax or traditional IRA money and send it to a charity. And if you're in RMD age, that charitable distribution will actually go towards satisfying your RMD. So let's say, for example, my RMD is $10,000 and I wanted to send $5,000 to the Red Cross and $5,000 to the Make-A-Wish Foundation. I could do that out of my IRA. I could send 2 checks out of my IRA to the Red Cross and Make-A-Wish Foundation, and it would, 1, benefit them. 2, I wouldn't have to pay any taxes on it. And 3, it would satisfy my RMD. Pretty nice. So again, a lot of clients do qualified charitable distributions, especially if they already gift to charities anyway. You can tithe to your church. You can obviously give to multiple of charities that are 501c3 organizations. It's a great planning tool, especially to look at year-end tax planning. Another one is regarding gifting. Gifting, the IRS allows for $19,000 to be given to any beneficiary at any time, and then you don't have to report it. That can be a good thing to look at how much you've gifted, or if you desire to gift, to do before the end of the year, because they do look at it at a calendar year timeframe. Next one, I just had a conversation with a client just this week about capital loss carry forwards. This is what you wanted to write home about, I know. But let's say, for example, you owned McDonald's stock and it went down and you lost $10,000. Over time, every year, you can technically write off $3,000 of that loss. Or you can offset capital gains. So let's say, for example, and this is specifically in non-retirement accounts, right? This is not in your IRAs. This is in non-retirement or brokerage accounts. So let's say that McDonald's stock, in this example, lost $10,000, but your NVIDIA gained $10,000. You can technically offset or sell the NVIDIA stock, offset those gains with that loss. So that's great. But you can also carry it forward $3,000 to write off on your taxes every single year until it's depleted. Number 9, it's important to look at, again, your total income to determine how much of your Social Security will be taxed. There are earnings thresholds that have existed since 1985 that determine, it's usually a calculation called provisional income, which we might do in a different video, but calculating provisional income and then looking at the income thresholds will determine how much of your Social Security is taxed. For most married or couples who are married filing jointly, anything above $44,000 of total income, your Social Security is going to be taxed, and up to 85% of it will be taxed. Not taxed at 85%. That's a very, very important distinction, but up to 85% of the income can be taxed. Number 10, also something very, very important to look at for anybody above age 65 is IRMAA. And it's not your great aunt IRMAA. It's actually income-related monthly adjustment amount, which is essentially how Medicare determines how much cost you should have for Medicare Part B and Part D. The more income you have, the more you pay. And it's also a 2-year look back. So for example, let's say I had a killer year this year and I made $250,000, which is awesome. 2 years from now, that is technically above an income threshold for IRMAA. So I would pay more for my Medicare Part B and Part D than if I only made $150,000 as a married filing jointly person. So that's the 10-minute Type 10 for year-end tax planning from SPG Advisors. If you want to like, subscribe, we would love it. And we look forward to seeing you at our next video. Cheers.